Let's hone in on that headline story now. First quarter data for South Africa's gross domestic product will be released by Statistics South Africa today, with expectations of marginal growth on the back of strong output in mining and manufacturing. The global economic recovery has led to increased demand for commodities, with South African mining output benefiting from high prices. But worsening unemployment numbers, fears of a third wave of COVID-19 infections and power outages just some of what would have prevented a repeat of strong fourth quarter data, where the economy posted annualized growth of 6.3%. Let's unpack the story for you now. Alexander Forbes' chief economist, Isaah Mhlanga, joins us now via our video link. Isaah, great to have you on the show with us this morning. Is there a need, is there a sense that we can be at least a little optimistic from these first quarter results?
Indeed, if we look at expectations in December last year, economic growth is likely to have grown much better than what we expected then. Our forecast is for a growth of 2% on a quarter-on-quarter annualized basis, but it still leaves year-on-year growth at just about -3%, which means if we compare first quarter of this year relative to first quarter of last year. But we also have to take into account that normally, because of seasonal effects, first quarter growth tends to contract because in the fourth quarter there is a lot of activity. People spend much of their spending which they would need in the following quarter, and as a result, we typically see a decline in GDP growth in the first quarter, but this time around we are expecting a positive print. We already have monthly indicators from the mining sector, manufacturing, retail and wholesale, just to name a few, that already indicates that the mining sector grew by about 16.5% on a quarter-on-quarter annualized basis, manufacturing about 1%, retail sales 6%, wholesale sales about 12.4%, all adding positively to first quarter economic growth. What is uncertain is the financial service sector, which tends to track the gross value added much more poorly. That is where the uncertainty is going to lie. But in terms of the ranges of forecasts, anywhere between 1.5 and just over 5%, but we are at about 2% in the first quarter.
Yeah, so according to what you're saying, most sectors tracking some growth, mining, manufacturing, retail. Is the challenge now to sustain that kind of growth?
Indeed. What is also important is the base effects. If we are looking for the year as a whole, if we just move away from the quarter, we just need to remember that 2.8% is base effects, which means even in the event that quarterly growth from the first quarter to the fourth quarter of this year is 0%, its growth is going to come up at 2.8% overall, simply because last year's growth was really very low, so we're growing from a low base. But if we just look at the incoming quarters, what is going to be quite key, one is the level of restrictions that are going to be imposed as far as the COVID third wave is concerned. So far, the lessons that we have learned from last year is that the economy has been better managed in the second wave compared to the first wave. Only two sectors were impacted significantly in a negative direction in the second wave, which is transport and trade. All the others were cushioned. Yeah. Which is quite in contrast to what we saw in the first wave of the pandemic, where almost every quarter was impacted. We expect a similar impact going forward, but even such sectors such as alcohol trading have not been closed so far, which is good, which means we shouldn't expect as much a negative impact as we saw in the first quarter of last year. But also, if we just look from a global perspective, global growth is expected to continue to outperform previous expectations, which means our exports are going to continue to perform in a positive direction, particularly mining exports. And we've also seen commodity prices continue to perform quite well, which has supported the currency as well. So indications are that we are likely to end up with a much better economic growth this year relative to what was expected in the fourth quarter of last year. But to sustain that economic growth beyond this year is going to require a lot of investment, which for now is not doesn't show signs of materializing at a faster pace.
Yeah, sustaining is one issue. The other issue is, even though there are lots of positives, as you've just pointed out, it's still not the kind of growth we need to break into those unemployment numbers.
Absolutely. And what is important to mention with the unemployment numbers is not the fact that we will not be generating jobs that will lead to an increase in unemployment numbers. It is the fact that there are more people entering into the labor market than the jobs that the economy is creating. So even in the event that the economy continues to grow, it will moderate next year, roughly about 2%, which means what the number of jobs that it's going to generate will be too few to accommodate the number of people that are entering the labor market. If we just look at the growth of the labor force, it's about 1.5% or higher. If you look at the rate of the economy as growth, is likely going to slow down, and it has been below that for a number of years in the past, which means we need investment in sectors that can generate more jobs than what we have seen over the last decade for us to make a dent on the unemployment numbers.
And how much of a deterrent to what you've just spoken about, investment in sectors that can generate more jobs, how much of that is being impacted by continuing blackouts, and perhaps as well, as we continue to battle the COVID-19 pandemic, the slow pace of vaccine rollout?
It is a big problem. There is no mining company that is going to come from offshore and sink a shaft in our country if it is not guaranteed security of energy. There is no manufacturing company that will come here and establish operations if it is not secured in terms of the supply of energy. It just doesn't work that way. The inputs at the very least needs to be available, and then we can deal with the issue of pricing. At this point in time, it is too expensive. That's why, for instance, our steel manufacturing sector is not performing to the same extent as what we see in the likes of China that have cheaper energy. So price matters, but also in terms of the actual supply. You need electricity, is not there, so how are you going to operate? So it is a big deterrent that we hope is going to be relieved as we move along, but it can't be done sooner enough than what we would need to see.
And I mean, Isaah, it's not something that we're going to, it's not a challenge we're going to fix in terms of our rolling power cuts in the country in the next year. So what does that mean for the next 5 years recovery, let's say?
Look, indeed, the Department of Mineral Resources and Energy tells us, together with ESCOM, that we will still have load shedding until end of 2022 at the very least. A more likelihood is going to be beyond that if we just look at the history of how the promises of bringing more energy to the grid have been missed year in, year out. So we can expect that it is going to take more than 2 years before we can get some energy security in one way or the other, which means we will have a natural cap in terms of how fast the economy can grow. Just imagine in 2020 when the economy contracted the most since 1920, we had the highest level of load shedding, which means as the economy recovers, as the demand for electricity recovers, we will have more load shedding simply because the economy is not generating enough energy. So that is going to be a natural cap on how fast we can. So we want the economy to accelerate, but we have placed on it the natural brake that we press ourselves to say we shouldn't grow the economy as fast. That's the situation that we are in.
Yeah. And a devastating situation it is, given our unemployment numbers specifically. Isaah Mhlanga, thanks very much for that detailed analysis of what we can expect today, how it impacts our recovery in terms of COVID-19 and specifically as well, getting rid of blackouts in the country. First quarter data for South Africa's GDP released by Statistics South Africa. Thanks very much indeed, Isaah.